Actually, the short answer is not yet. While I completely agree, India is always a structural growth market and it's a structural growth story, and one can never be bearish on India on the long term. But in the here and the now, despite the market correction, as you mentioned, since September highs, we continue to be cautious on the market. We think that this is a year of market consolidation in India. We are expecting only single-digit dollar returns from the Nifty this year, which is obviously quite tepid, especially in the context of 10-year bond yields already at 465. So if you can make similar returns from a risk-free asset, which is treasury, then the returns rather from equity has to be higher. With the lukewarm returns, we would argue that it's still time to be cautious. You would probably get better levels to make an entry. And I think as investors look for protection of their capital as opposed to returns this year, even the market breadth is likely to narrow this year.
Wow. Was the Adani issue and the impact that it had on the infrastructure sector and listed infrastructure names, of which Adani is a mainstay, how problematic was that from a perceptions point of view?
So I would argue that private sector capex in India is still not a very relevant part of the overall capex pie. Over the last 7 odd years, capex growth in India has primarily been driven by government spends. So I would argue that the capex spends coming off this year is more about Indian government policies trying to now balance consumption slowdown along with capex growth. So over the last few years, it was all about capex at the cost of cutting subsidies. Now we have got some subsidies make a comeback in order to support consumption. And as a result of that, government capex has come off, which is one of the key reasons why you see the correction in the capex-focused stocks and sectors as well.